Hey guys, TommyBryson here, and what is an asset and what is a liability and how can it help me when it comes to wealth building? By the way, this video is for wealth building, not really the balance sheet definition of an asset and a liability for accountants and investors out there. Now, if you are an accountant, trying to be an accountant, I recommend this book right here, Accounting for Dummies. I also recommend this one right here, Accounting Workbook, also for Dummies. By the way, sounds funny, but these are great books when it comes to accounting. I'm not joking about that. And also for investors, if you want to interpret financial statements, I recommend this small book right here. And it's called Interpretation of Financial Statements by Benjamin Graham, the father or the godfather of investing. But quick synopsis here, assets can be liquidated into cash very fast, very quickly. So short-term assets, less than 12 months, that can be, for example, cash or accounts receivable, because again, it takes less than 12 months to make those into cash. But long-term assets take more than 12 months to turn to cash. For example, that can be land or machinery. And as far as like liabilities, usually things you owe money on, for example, short-term liabilities take less than 12 months to pay off, or 12 months or less. That's the idea. So what is that? Like accounts payable or wages payable, like all those things right there, less than a year to pay off. That is short-term liability. Long-term though, that can be, for example, you issued out a bond or you have a loan. It's gonna take more than 12 months to actually pay off. That's the whole idea. But again, this video is not about that type of accounting. Although I graduated as an accountant, I find it kind of boring, honestly. But again, you need accounting to be an investor and to also analyze investments. So I always recommend learn accounting. It is the language of investors. So again, these are the books if you want to learn about that. But this video is not really that deep, okay? Now, first things first, guys, okay? If you're new here, subscribe. You're welcome. Join the long-term family. And as always, destroy the like button and let's get right into this video. Now, as far as, for example, wealth building, okay? Assets and liabilities, what do I mean here? Well, I love the definition by Robert Kiyosaki. If you haven't heard about this guy, he's like super famous and he created, for example, Rich Dad Poor Dad and that whole series. And you know, although I don't agree with everything he says, the guy's still solid. His information is solid. But again, don't ever read something, think that person is, for example, everything and knows everything, and don't question it. Learn to question things, especially me, especially him, always questions everything to make sure you fully comprehend everything. Because I used to agree with everything, but today I don't agree with everything, okay? But the definition is basically assets put money into your pocket, okay? Liabilities take money away from your pocket. And the cool thing is that basically an asset for me can be a liability for you. For example, if my name is Dirty Tommy, okay? And I go to you and I say, hey, can I borrow $1,000? And you lend it to me? Well, guess what? On my books, on my balance sheet, that's a liability because basically it costs me money to have that money. However, for you, because it's making you money, that can be an asset to you. That's the cool thing about liabilities and assets. It all depends on what it's actually doing for you. So what are some examples of assets and liabilities? Well, an asset can be, for example, I put money into stocks, into investment properties, into mutual funds, into index funds, into things that are gonna make me money. But then you also have, for example, sus assets, okay? S-U-S, meaning suspicious assets. Now, what do I mean here? Well, would you consider a personal property an asset? The answer is most likely, well, yeah, kinda, but does it put money into your pocket? Not really, right? You have, for example, like the appreciation every year, hopefully, if you didn't overpay for it, but you have appreciation, right? Every single year. If you bought some real estate, you bought it for 100K, usually on average every year, it goes up by like around 5% to 10% or whatever, and it goes up, it goes up, it goes up. But in reality, that's not money that's actually in your pocket because it's not really liquid, right? So you are actually paying a lot of money to have this asset. For example, you have the maintenance, that costs money. The roof broke down, the AC broke down. Oh my gosh, the grass needs some mowing. All the stuff costs money. You also have taxes, never end. You also have, for example, if you paid a mortgage, you also have, for example, the interest on it. You have, for example, the insurance on it. You have potentially an HOA fee on it. All these things, they call it phantom costs. So although a house, a paid off house can be an asset because it gives you security and it also lowers your expenses by a lot. Well, in reality, it's not like this massive, great investment. So I change that perspective a lot because, again, I'm gonna buy my house, I'm gonna pay it off, but I don't see it as an investment. I see it more as a security factor, because in reality, this way my expenses are lowered by a lot. Also, would you consider our car an asset or liability? You might say, I know this one, liability. It goes down in value, and on top of that, also, it takes money from your pocket. But what if this car, you're actually a taxi driver, or it's actually a van? Is it still liability? The answer is no, because you turn this liability into an asset. So my point is, okay, question everything, okay? Because you can turn a liability into an asset. It all depends on how you use it. So for a lot of us influencers, a phone is an asset because we make a lot of money from this little device here. But for most people, it's a liability because it goes down in value and it also costs you money with all subscriptions and everything else that Apple does, okay? So what are some examples of liabilities? Well, electronics, like iPhones, MacBooks, iPads, but also buying a crazy expensive house that makes no financial sense. Also credit card debts, personal loan debt, cars that are too fancy and go down in value like crazy and it's not really an asset for you. And on top of that, also student loan debt. You might say, Tommy, well, student loan debt enables me to get an asset that makes me money, but in reality, it's not that simple, and I'll break it down later on because that's usually you using leverage or OPM to actually go ahead and get something that could potentially make you money. But for most people, they never pay it off, and it usually doesn't make them that much money, okay? So we'll talk about that more later in this video, but you also have some good liabilities. For example, a mortgage can be a good liability. So it's not like all liabilities are bad, all assets are great. No, it all depends on how you're actually utilizing it and for what end also. So now you know, assets put money into your pocket, usually go up in value. Liabilities usually, okay, go down in value and take money from your pocket. But although sometimes you could have different up and downs and it could be considered something else depending on what you're using that liability or asset for. It all depends. However, though, guys, now that you know this, what are we supposed to do with this information? Well, the overall goal is that if you exist and you're alive, you're always going to have some level of liabilities, things you have to pay that don't really add any value to you, but you gotta keep paying it because basically the cost of life. So you're always gonna have that cost of living. So what's the goal here? The goal is to collect a lot of assets in life so those assets can pay all your liabilities plus more. That way you have financial freedom and you don't need to work if you don't want to. You have that freedom to be able to do that. But to acquire assets, which by the way, usually are not cheap and not that easy, don't believe the hype. It takes some money, it takes some knowledge, it's just how it is. Because if it was easy, everyone would have them, let's be real here. But the idea is, how do you acquire them? How do you acquire assets, okay? The answer is, you have two ways. You have leverage / OPM using other people's money to acquire them, or you have the long-term team way, okay? Which basically usually means the slow way, the boring way, the way most people don't want to do it, including the long-term team members, but they know the benefits, so that's why we do it. And by the way, if you don't know, I'm a part of the long-term team, all right? There you go. But overall, what are the pros and cons of building wealth, for example, with leverage or OPM? Well, the truth is that there are a lot of pros. And the main pros is usually you can get to your destination a lot faster, which usually is financial freedom. Because usually people use OPM leverage to buy real estate properties, to buy, for example, stocks. How? Well, you can buy stocks usually with like a margin account. So you basically borrow money from those assets to basically buy more assets. And basically, before you know it, you can get to your goal a lot faster. Or you ever heard about like Burr on TikTok or Instagram or YouTube? Burr, basically meaning you buy a property, you remodel it, you finance it, well, refinance it really, and then you go ahead and basically rent it and you repeat because you cash out the refinance money, you use that money to buy another property and another one and another one, but you always owe money every place you go. But then the tenant there pays for the mortgage. So that's a lot of leverage there. Meaning, hey, I'm leveraging this debt to make me more money, make me cash flow, and then that cash flow is going to pay for my cost of living, aka my liabilities. This, my friends, is called leverage. Now the problem is that leverage is also a double-edged sword, because when things go wrong, they go really wrong, and they double in magnitude. So if you lose money and all you lost is your money, that's fine. But when you lose other people's money, well, now it's a whole different game. You got foreclosed on, it's an issue. Or for example, the market went down, now your margin account was going crazy, that's an issue too. So OPM, leverage, that's the risk. The gains are magnified, but also the losses. And the big problem is that, again, it's a double-edged sword, but every single person out there thinks that they're a samurai and they are an expert and everything's gonna go well. But usually they're the ones going bankrupt and the ones that are going through a lot of struggle and usually cannot sleep at night, okay? So be careful when it comes to OPM, and that's not really what I do here. But again, not all OPM is bad, okay? I'll break that down later in the video. But what's like the long-term team method? What it usually means, hey, I'm gonna take this step by step. I'm gonna build a foundation. I'm gonna pay off my debts. I'm gonna make my safe investments. My investments will pay for my lifestyle. I'm gonna pay off this home. And then when I wanna basically invest into property, I'll do it in a safe manner that does not put me at risk. Now, honestly, this takes a lot of time, because remember, to buy a property for like $200,000, it's a lot of money. Get all that money to build a portfolio that can basically pay your cost of living. It also takes a lot of time. It takes compound interest. This takes a lot of time, and it's also boring to do it in a safe method. But that's what the long-term team basically does. That's what we do. And the way I read it, for example, I think it was in a book or a movie, I really don't remember, but it said it's like being on a highway. And we have the same exact cars, okay? Same cars. Now this highway, it's you and me and a lot of other cars. Now every single other car are just obstacles that can basically switch lanes at any time, brake at any time, anything can happen. But the cool thing is that there are no cops, but there is a speed limit, okay? Speed limit here is like 50. You can go 55, 60, but beyond that, it gets a little dangerous. Now, I go 50, 55, 60, long-term team, right? So if someone brakes in front of me, I can brake also, I'm fine. If someone switches lanes or tries to cut me off, I'm fine, because I'm not going that fast. But then you, usually like the leverage OPM people, they're going a lot faster. They're going like 120 miles. Now, they can be excellent drivers, NASCAR drivers, but if something unexpected happens, results in a car crash or a bankruptcy in financial terms, okay? Or things go very bad, you know? And that's why you hear all those stories about, I made so much and then I lost it all. I made so much, but now I owe all this money. What do? I lost my job. That's when you hear all those crazy concerns. Because in reality, you're going faster, you're gonna get there faster, but the risks are so much higher. When you get there, you'll get there in half the time it would have taken me, but the risk is that if things go wrong, they really go wrong. You know what I mean? So that's why I call it a double-edged sword, and that's why I told you an example, because it kind of helped me understand it fully, and I hope it did the same to you. Now, you're probably wondering, guys, okay, Tommy, I get it. The whole goal is you collect assets, they pay your liabilities, and you want to be careful how you collect them, because that way you don't get burnt if things go wrong, which it will do at some point. Now, what do I do as far as, for example, if I want to be a part of the long-term team, okay? Well, the answer is, it's very simple. What I do here, the first thing, guys, okay? If you don't aim at anything, you'll never hit anything. So it's very important you have a goal in mind. My goal is financial freedom. Now, the problem with that is usually that if your goal or your target seems so far away, it's very easy to kind of get depressed and be like, it's gonna take forever. Oh my gosh, I'm making no progress. So it's also very important to have little milestones to hit along the way to keep you motivated. And also, the last thing is, if you don't track something, there will be no way to actually improve it. So what do you do here? Well, first things first, you got a budget. Your budget is gonna tell you the money you have coming in. For most people, your job is going to be your number one asset. It makes you money, all right? it usually doesn't take money away from you. Makes you money, all right? That's your number one asset. But then your liabilities are going to usually be your cost of living because it costs money to be alive, all right? It's just what it is. So what are the needs? The needs are shelter, utilities, food, and transportation. Everything else usually is gonna be a want and you wanna cut it off, all right? So once you've done that, you're tracking your income, your expenses, you cut off the inefficiencies, you fired those things, you no longer have it. What do you do next? You save $1,000. That way, if things go wrong at any moment, you have that little like seat belt around you, right? Just in case. And then you start paying off your debts and using, for example, the avalanche method, all the debt except the mortgage. Now, what is the avalanche method? Brief synopsis here. It basically means you pay the debt with the highest APR first. The balance does not matter, only the APR matter. Why? Because this way you save more money mathematically. That's the idea. So you start paying all the extra money you have left over into those debts. Once you're done paying off the debts, you work towards saving up 3 to 6 months of emergencies. This is the equivalent of having, for example, an airbag and a seatbelt in your car. Because if you do crash at any point, at least you have an airbag, so you'll be fine if you're traveling at a safe speed and things are going fine, okay? So that is gonna give you like this wiggle room in case you got fired or things change at your job or you get like reduced hours, okay? Having 6 months worth of expenses is gonna help you out a ton. Once you have that money in a separate account and you don't use it for anything else, you start to invest. Investing now is the equivalent of, now I'm gonna build my assets through index funds or mutual funds, whatever you wanna do. I do ETFs and I also do index funds. I have videos on those things, so I'll link some down below in the description. I'd only invest 10 to 20% of my income because that's just one part of wealth building, because the next part is you buy a house. Now the house you buy, a house can either make you or break you. If you make a good amount of money and you listen to the bank, they will give you a house that you can afford the payment, but you can't afford the price tag because it's that expensive. It's gonna cost you so much money. So my advice is, and what I follow is, the house I buy can only be 33% of my monthly income, including the mortgage, taxes, insurance, maintenance, and everything included, on a 15-year mortgage. If you can afford that, great. It's gonna be a limited house. You can actually afford it and cover all the bills with no problems. And the goal is, if you're investing, you also bought this house with the extra money left over, you put it towards the house to finish it off in 8 to 10 years. Now, once you're done with that house, you can basically go ahead and say, hey, 10 years later, I have a bunch of money in my investment account, I have a paid off home, my cost of living is a lot more lower, and I'm able to just enjoy my wealth a lot better. Now, this sounds cool, but think about it. It can take you years to be debt-free, months to build up an emergency account, years to pay off a house. These things take time, and that's why it's called the long-term team way. Or you could use leverage and debt to say, well, I won't pay off this debt. I'll buy some properties, I'll invest some money, and I hope that nothing goes wrong, and I'll be able to outperform my debts and the interest it's costing me. That's the risky part. But if things go wrong, you're just like, I had this much debt, but now I have this much debt, and now you just put them together. That's the problem with that technique, okay, guys? So my choice, long-term team. But yeah, guys, overall, that is it. When you think about an asset, think about, for example, puts money in my pocket and goes up in value. When you think liability, think about takes money from my pocket and also goes down in value. And like Benjamin Franklin said once, be careful the liabilities you buy, because usually they force you to upgrade your lifestyle. If you buy an iPhone, guess what? Before you know it, you'll need an iPad. I have an iPad. If you buy a fancy car, before you know it, you'll need a watch to go along with it. I have a fancy watch that cost me $15 at Walmart, okay? But that's the idea. Be careful buying those liabilities that need like upgrades for like lifestyle looks. Be careful, okay? First thing comes first, and first thing is usually financial freedom, and then you get to enjoy the fancy things in life, okay, guys? I'll see you guys tomorrow. Thanks for watching. Like, subscribe, hit the bell so you're notified. If you want to call me, the link is down below. If you want more content like this, here's a video right here on investing, and over here's my face. Click it, subscribe, and peace out. Long-term team out.